right, everyone, you heard about the three important pillars we've been talking about. Just now, insurance, before that, the importance of accounting practices, and what's going on with regulation. But now we're talking about the money. So very interesting to hear what's going on with M&A, including debt, and then followed that, some investment discussion about what's going on in the investment world. So please, I welcome to the stage Neil Kaufman. Come on up. Neil is a seasoned lawyer with Kaufman McGowan, which is a really important leading firm in New York. Have a seat, Neil. Neil is active forming and reorganizing corporate groups and counsel to clients, and very active in cannabis now for many years. Have a seat, Neil. I welcome to the stage David Feldman. David, you're a consummate securities lawyer. Look at, we're getting clapping. This is wonderful. Welcome, David. A consummate securities lawyer, well-trained at Wharton, but so knowledgeable that he has turned his legal savvy into a consulting firm called Skip Intro, meaning let's get to the heart of the matter. And also, he co-led a 60-person legal practice in New York, so very smart and knowledgeable. Joe, come on up. Joe Combarato. Joe is CEO and co-founder of the National Business Capital, which is a leading fintech marketplace, helping entrepreneurs with all kinds of competitive financing and helps companies outpace their competition. I love that. Neil, take it away. Teach us things we don't know. Help us understand what's going on, both for debt and M&A.
Thank you, Jean. Thank you. So before we dive into the substance, the burning question in my mind that I know many of you may share is, I need to ask my old friend Dave here. Dave, the name of your firm, Skip Intro, is that a reference to, the gravitas and reputation that you bring that allows your clients to skip any introductions, or is that a reference to the little box in the corner of the Netflix screen?
Yes.
Great. Just what I needed to know. So.
Hello. Just turn it on. I can turn it on.
There you go. So we're going to discuss, as Jean mentioned, two of the hottest trends in the cannabis industry: debt financing and mergers and acquisitions. We've noticed that hedge funds have jumped into the secured lending segment of the industry, filling a gap in financing for many cannabis companies, given the weakness in the equity markets. And in the M&A markets, we've also seen a little bit of a slowdown and more and more distressed sales. So, Dave, can you start off by explaining to us the differences between secured credit facilities and the kinds of convertible note financings that we've long seen in the cannabis industry?
Sure, and it doesn't sound exciting, but it's an important distinction to understand. Secured lending simply means you're borrowing money against some collateral that you offer up to the lender, whether it's equipment, whether it's real estate, whether it's accounts receivable or something like that. And that has been the traditional way that banks lend money to businesses as they grow. They want to have some collateral. And the secured aspect means that they have what's called a lien against those assets, which means if you don't pay back the loan, they can basically come and take your assets as a way to repay the loan. And they file that lien with the state so that the world is on notice that that lien exists, and nobody can get a lien ahead of them unless they agree to it. In unsecured lending or convertible notes, which are very common in cannabis as well, there's some secured lending in the cannabis space, especially where real estate is involved. Really, a convertible note sounds like borrowing, but it's really equity with a backup plan, is the way to think of it. The investor buying a convertible note wants to own a piece of the company. But typically what happens is, especially with early stage companies, you have trouble figuring out really what the value of the company is. So if you're going to buy equity, if you're going to buy a percentage of the company and you're putting in $1 million, well, what percent should you get? What's the value of the company? And that's often hard to do in the early stages. And so you kind of get to punt on that with a convertible note by saying, okay, we're borrowing money from you, the investor, and it will convert into equity ownership, but only when we do our next round of financing. And you, as the investor today, get a benefit over people investing in that next round. Namely, you get a discount to the price that the next round guys get. So if you're doing a convertible note today and you do a financing at a $10 million valuation in a year, and the note is converting into that, then the investor typically gets a 20% or so discount to that valuation. And so what's interesting, the last kind of piece about convertible notes is you have to, as advisors, protect both the debt and equity sides of that convertible note. So you see very similar provisions in venture capital deals, such as board seats and rights of first refusal and the right to participate in future things. And then some of these notes also let you convert into equity at your option at some point, not just in the next financing. But that is less common in the cannabis industry deals.
And sometimes with a fixed price as well, if you can agree on that.
Correct, yes. And that is how they typically do it. And that's where the valuation does take place. So that's why they tend to not put those in, where you say, we want to have the right to convert this note into equity, even if there isn't a financing. And then you say, well, the right to convert at what price? And so you have to decide that now, which is sometimes difficult to do.
Right. And the advantage of that also, though, is when maturity comes, it can provide at least a mechanism for the company not having to pay the money back.
Correct. Well, right, but it would be at the option of the investor. But you can always negotiate that at the time. Like if you don't have the right to convert into equity, but now you didn't do another financing, you didn't convert it, you're sitting with this promissory note, and it's due, right? You've waited a year, you've earned interest, and now you want the company to pay you back. They say, well, wouldn't you like to convert? And then you can have a negotiation and say, well, let's convert at whatever the value is now.
Right, right. And so for a long time, convertible notes have been very popular in cannabis, as well as straight equity financings. A few years ago, professionals like us were sitting around telling ourselves things like, boy, we really would like to see an increase in the professionalization and the institutionalization of the cannabis financing industry. And lo and behold, over the last few years, we've seen the rise of this secured lending, which very much resembles bank debt in all of its terms, conditions, covenants, et cetera. Thus, we kind of got what we wished for. That comes with some interesting cannabis-related questions. I'd like to ask Joe, from the standpoint of the lender rather, how does a lender protect themselves in a secured lending context when there is no ability to use the U.S. bankruptcy laws because cannabis companies are not eligible for bankruptcy, and you can't foreclose on the inventory because you need to have a state license in order to take possession of the inventory? So what is a lender to do?
Yeah, so it's a good question. Some of the transactions that we've been doing, and my team and I have done about 25,000 transactions since we started in 2007, $2 billion in funding. We have over 75 lenders on the platform. So we work with a number of different lenders. Some of those lenders want it secured as equipment. You can take back that piece of equipment because it's not the inventory.
Equipment liens.
Yep.
Absolutely.
And then some of the other transactions that we've been doing really just been over pure cash flow. So just looking at the business, the cannabis business, understanding their cash flow, and maybe we'll do a line of credit or a term loan piece just purely against their cash flow, and then also look to fund other parts of the business using equipment funding, whether it's a grow operation or if they're extracting, things like that.
And there's been lending in what we call the ancillary businesses, which are not plant touching, are not growing and selling weed. And so if you're a manufacturer of equipment and you're borrowing money, it's not a problem to worry about these issues of bankruptcy and so on.
Right. So with respect to cash flow and low lending, that raises an interesting question. Many times we see lending capacity measured based on a multiple of EBITDA.
Yep.
Now, and we see that in the cannabis cash flow loans also. Of course, the thing is, for cannabis companies with 280E, the amount of taxes that you need to pay is actually quite significant and significantly larger than a normal company. So what do you guys see in terms of how do lenders measure that cash flow based borrowing capacity in light of, sort of ignoring taxes is kind of crazy in the cannabis industry?
Well, that's actually a good question. We actually, in my lending partners and deals that we'll syndicate on, we're not a big fan of using EBITDA as a model for lending. We're a fan of looking at real cash flow and understanding your true ability to pay. And I don't really think EBITDA is the best way to look at a company and their actual profitability, because those things that you are paying are real.
Exactly.
Interest, taxes, so we look at we look at other things, more just the ability to pay back. What's happening now in the business? What are they really using the funds for? Where are they currently, and where are they really going? And what by borrowing X amount of dollars, what is it actually going to do for the company?
Which is interesting because equity investors typically use a multiple of this year's projected adjusted EBITDA as the way we value businesses in this industry, which is different from how you're looking at it. And that's just a kind of interesting conundrum.
It is. So let's shift gears a little bit and talk about M&A. Dave, can you sort of tell us, describe for us some of the trends that are active in cannabis M&A deals, MSAs scaling, some of the mega mergers, distressed sellers, foreign and other non-industry buyers coming into the industry?
Sure, let's go through it, and I have a couple of notes to remind me. So last year, and Elena covered this a little bit in the accounting panel, but we'll dive a little deeper now. In 2021, last year, it was an absolute banner year for M&A, best year ever. There were 190 M&A deals in the industry worldwide.
None of us got any sleep.
It was very true. And it was worth about $20 billion of deals. This year, the volume is down 80% from last year. And however, if you disregard two giant deals last year, it's not down 80%, it's down around 50%. But that's still a lot. And this year, in the US though, that was global numbers. So in the US, we are only down about 37% from last year. And that number will probably catch up because there are two mega deals in the US, the Cresco Columbia Care deal and the Verano Goodness Growth deal. When those close at the end of the year, that difference will probably be a little bit less.
But in the meantime, we all have time to spend the weekend in the Hamptons.
Well, I've been dealing with a lot of emails today, so I don't know about you. So in terms of the topics you just mentioned, the MSOs scaling for legalization. So the model, since we started having multi-state operators, they all pretty much have the same idea. We want to get as big as we can, as fast as we can, from a revenue top-line perspective. Why? Because when federal legalization happens in the US, we want to be the most attractive acquisition candidate when big tobacco, big alcohol, big pharma, et cetera, come in, presumably, and start making acquisitions in the space rather than trying to do things on their own. And that trend is continuing. But this year, as Elena noted, the volume is way down. And the reason the volume is down this year is because stock prices are way down. And the way these acquisitions get structured is it's a combination typically of cash, note, and stock. And so the two problems they have right now are the stock prices are low and they don't want to give up the stock at such a low price. And also these companies have cash but are having trouble raising new cash at the moment. Or if they do, it's too expensive and they'd rather not. And so they're okay for the most part, but they don't want to use their cash right now for too many acquisitions.
And a lot of them are running out of cash very rapidly because they're burning it like paper.
And some of these deals are structured as with big earnouts, and earnout means part of the money you're getting to sell your company doesn't come till later, and only if the company performs at a certain level. There are also what we call adult use bonuses in states that have only medical marijuana, that when you sell your company today, let's say in Pennsylvania, which has not approved adult use yet, the seller says, I want more money when adult use happens because this license will be more valuable. And so the challenges we're seeing in those kind of deals. They move too fast. Due diligence isn't always as careful as it should be. There's some unsophistication of some sellers, which makes it difficult, and things like that. But when ancillary businesses sell, it's a little bit different. It's not just the growers and sellers that are looking to get out. If you're a smaller equipment manufacturer, you may worry that when big, giant mainstream companies come in, you'll get crushed. So those companies, even if they're doing well, may not want to continue independent at this point.
But in the meantime, though, we have started to see some of the tobacco and alcohol and pharmaceutical companies get involved with agreements to acquire in the future once we have federal legalization, where they have options to buy some of the major cannabis companies.
That's happened more with Canadian cannabis operators coming into the U.S. and saying, we have gone public, we are federally legal in Canada, we got NASDAQ to give us a listing on NASDAQ. NASDAQ will not list U.S. plant-touching companies. So the Canadian companies don't want to lose their NASDAQ listing, so they're making deals with big U.S. companies to say, we want to acquire you, we're going to agree to acquire you now, but not until federal legalization happens, or something like that. And you have to be very careful if you're looking at investing in these companies, because their press releases on how these things are structured are not entirely consistent with the actual language in the agreements when you actually pull them, which is not easy to do.
Yeah, you have to find them on Cedar, and everything's on PDF.
It's hard.
So that has definitely happened with Tilray and some of the other NASDAQ-listed companies. But we have seen Altria and several liquor companies and one of the pharma companies also start making similar option type deals or investments through intermediate funds with complex structures. And I think what that tells us is that the thinking that Dave was alluding to of getting big so that when the big tobacco, alcohol, and pharma companies come in and scoop up the industry and consolidate it, it's really already starting to happen on some level as best they can.
And the but is that they're making an agreement today to acquire you someday in the future that isn't known at a fixed price that they agree on now.
Yep.
And a number of these deals were done when the stocks were high. And when the stocks plummeted in the last year, some of these deals got renegotiated. I don't understand the logic of agreeing on a fixed price to acquire a company at an unknown date in the future.
Well, it's complicated, and we don't have nearly enough time on this panel to get into those details. But one of the things that we're seeing in the acquisition market is an increasingly large component of them being financed with debt, including some of this new secured debt. So, Joe, we want to address what role is secured debt and other types of debt playing in financing the M&A market?
Yeah, I mean, what we're starting to see is I think it used to be where people were only looking for private equity, and now I think private equity included, people are considering financing a combination with private equity as well too, and we're even seeing we're doing deals where we're working with a private equity firm, and the customer, and kind of bridging the gap and bringing in additional sources. So we just did a transaction where someone was acquiring company. We brought in a credit line piece, and then they had to finance a bunch of equipment and stuff when they closed. So we financed all the equipment. But they only had X amount of equity, and we came in to fill that gap, and together worked as a team, with the private equity investors for the company that they were acquiring, financed that additional equipment, gave them a credit line to scale and grow the company. And another thing where I think people are really starting to change and look at things is they're saying, hey, you know what, I can finance these things. I can finance equipment. I can pull a credit line. I can leverage my cash flow. So maybe I should use my equity for other things instead of just we just financed a $850,000 pre-rolled machine over 5 years at a pretty decent rate considering it was cannabis space. They would have used their equity for that in the past. Now they can finance that, stretch out the payments over 5 years, and they can put that equity towards, growing, scaling the company, marketing, and other things that maybe aren't easily as financed.
Okay, well, thanks, Joe. So you talked a little bit about some of the sort of non-traditional types of financings that are available to cannabis companies. Things like merchant credit card cash advances are more difficult because credit card processing is generally not available to cannabis companies. We talked a little bit about equipment financing. We've seen a lot of sale leasebacks. The market for that has maybe been chilled a little bit in light of IRPR's issues with Kings Garden's default. What types of financing do you see being available to cannabis companies of the non-traditional nature?
So the merchant cash advance you can do, and it doesn't have to be through the credit card sales today. But we're offering term loan products, our revolving lines of credit, and then mainly equipment. And as I mentioned, I think in the past it was like one or the other. I think people are really being people are really open today to working together as a team and exploring all these options. And I think especially too. When valuations are down right now in this market, if you have an ability to leverage some cash flow and it makes sense, you don't have to sell equity at the wrong time. So I think it's just a combination, and not one or the other. Today, I think people are really starting to open up their eyes to that.
Thanks, Joe. So we're just going to circle back to M&A for a minute, and then we might have time for a couple of questions from the audience. Dave, could you just also address briefly the trend of mega mergers and distressed sellers?
Sure, and obviously two very different
Opposite
subjects.
ends of the spectrum.
So the mega mergers that have been happening, there haven't been that many. We're starting to see the big MSOs combine with each other. They keep leapfrogging who's going to be the new number one size company in the industry. These are very hard to do. Probably the biggest issue in these mergers is egos.
And license conflicts.
Well, I'm going to get to all that. I said the biggest issue is the egos of the leaders. Who's going to be in charge, who's going to run it. You have to get past that. Second, there is often a need to divest part of their assets, because if you have a limit on how many grows or dispensaries you can have in a state, and you're acquiring a company in that state, that can be a problem. State approvals for these deals can go on and on and on for months. There is no time limit. They can take as long as they want. State employees, can be great or maybe cannot be great. And so what we're mostly seeing are deals where there are not so many overlapping states, where somebody in the West is more acquiring somebody in the East, but there are still real challenges in these deals. But distress. So there is, unfortunately, but not surprisingly, an increase, as was mentioned on the accounting panel, of companies facing a lot of difficulties, saying, "Okay, we'll sell." And
prices have collapsed, and that's produced tremendous pressure on the cash flow and survivability of many cannabis companies.
Well, and as a result, raising capital has been a major problem, and that's why these companies, many of whom, in fact, most of the big MSOs, don't earn a profit. They are not profitable after all these years. They are still net loss. There are some exceptions, but for the most part, they're losing money. And so with distress, we tend to find that this is happening where, for example, there are states where there's a limited number of licenses. The MSOs have come in and controlled most of them, but then there are some independents left, and they're struggling because the MSOs don't buy from them and so on. So these are becoming distressed sellers. We're also seeing some distressed players in the hemp and CBD space because even though hemp has been legalized federally, the increase in supply that resulted from that was not kept up with the amount of demand. So prices plummeted, profits plummeted. There is now ongoing a shakeout in the hemp and CBD space that I believe is going to lead to an exciting period for hemp and CBD and other hemp-related products like hempcrete and other things in 3 to 5 years from now. But these distressed deals are happening there as well.
Absolutely, in both sectors of the market. So I think we've got about 4 minutes left. We can take questions from the audience if anyone has any. If not, we'll just keep blathering on.
Sure. Are you seeing in the M&A world, are you seeing the insurance transactions? In the M&A side, are you seeing from the lender requirement of insurance, M&A insurance
Good
or
question.
transactional?
You mean like rep and warranty insurance?
Warranty, correct.
I haven't seen it. Have you?
I haven't seen people ask for it, and I haven't seen it really be available.
I haven't seen it
to be
because
honest.
Yep,
is
we're
it
not seeing it
commercially
either.
available? I mean, we haven't seen it, and we're like in the trenches. Supposed to be a group coming out. Well, we
Yeah,
haven't seen
just
it at any closings yet. In the normal M&A world,
You should explain what rep
yeah,
warranty.
exactly. Very often, a one or both of the parties will pay for and purchase an insurance policy so that if there is a breach of a representational warranty by the seller, the insurance covers it. And it's a fantastic way, very, very popular in the private equity M&A world, to minimize risk for the sellers and really minimize risk for both sides because it provides that fund in case problems come up. We keep waiting to see that product available in the cannabis M&A space, and we'll be eagerly awaiting that.
And I'll tell you, it's not in case these problems come up. Something comes up in almost every deal. After you make an acquisition, the seller made certain representations to you about the business, and you find out when you really get in there, even though you've done your due diligence, that there was something that was misrepresented. Maybe not intentionally.
That is unless that the seller engages Dave or I to represent them, and they let us scrub the company thoroughly, which they don't always let us do.
Even then, we find issues in their pension plans that people did until you really dive in. I had a deal, a $200 million deal a few years ago, and it turns out that when they terminated employees, they didn't handle it right, and they gave them money that they shouldn't have given them, and they didn't want to go back and get the money back from these people, so that became a liability that they had to fund. So I always say it's not whether problems will arise, but what. And so all you can do is build as high a wall as you can to reduce the risk of that. And I think.
Okay. Seeing no other questions, thank you guys.
Thank you all very much. Have a great
Thank
evening.
you.
I hope you'll all be here at 7 o'clock for my colleague Courtney Barnes, who's going to give us an introduction to psychedelics. So hope you'll see you then.
Awesome. And thank you, Gary, and the team for bringing everyone together.